Welcome back to EDS, and in this video I'm going to show you a very simple strategy that you can implement into your portfolio, into your account, that's going to generate you healthy positive returns very consistently. We've also back tested it, and that's going to prove to you and show you the efficiency of this strategy. And then after we've gone through the back test, I'm going to show you step by step how to actually place this trade in your account. So let's have a look at the back test. The underlying that we chose to test was GLD, and the back test ran the past 3 years worth of data, so it's a healthy sample size. And the strategy is very simple. So what we did was we sold one put 30 deltas out of the money, and then we bought a put 15 deltas out of the money. So we sold one put and then we bought another put further out of the money. This is called a put credit spread, and we sold those with 45 days left to go on the contracts. So the entry conditions here, we only had one trade active at a time, so even if the backtest wanted to open another trade, it would wait until the previous trade was closed before doing so. And yeah, when maximum active trades is reached, don't enter a new trade. That just confirms what we just went over. And it only entered when the VIX was above 18 or between 18 and 40. So, and the reason why we do this is because volatility plays a role on option prices, and because we're collecting a credit on entry, we're effectively short premium basically, and when volatility rises, option prices rise, and whenever you're short, you want to sell high, buy low. So when volatility is also mean reverting and it contracts most of the time, so when volatility is high, we've got a good chance of it contracting, and when it contracts, that will reduce the option prices, which is going to help our short position. So that's why we waited until the VIX was at least 18. In reality, you would look at something like IV rank for the specific underlying. At the moment, GLD's IV rank is 62.7. Anything over 30 would kind of be okay to trade. Over 50 is very nice to trade. But because we couldn't actually use IV rank in this back test, we just used the VIX as a proxy. So in reality, returns would actually be a little bit better than this. And then the exit conditions were we exited at 21 days left till expiration, or at 50% of max profit, whichever came first. So this is the chart here. The gray line shows us the price of GLD, and the orange line shows us our PNL of the strategy itself. So as you can see, the strategy kind of moved, the price of GLD kind of moved sideways for the first half of the back test. However, our PNL was positive. So even though GLD itself wasn't doing anything in terms of price, it wasn't really moving anywhere, we were still making money. Okay, and then we've got these periods where our PNL was just flat, and that was because the VIX was not high enough, so we didn't take any trades during that period. And then GLD started to rise, and typically when underlyings rise, IV tends to drop most of the time. So we weren't taking any positions. However, then we did manage to pick up some positions here, some positions here, some positions here, and boost our returns a little bit. So let's look at the numbers. So if we were to just buy and hold GLD over this 3-year period, we would have made $431 profit. However, our strategy made over $1,000 profit, which is a major difference. And our average PNL per trade was $35.81 positive, okay, which was about 4.48% of the capital that we used. Our max drawdown was 29.27%, and the max drawdown for if you were to just buy and hold GLD was 21%. So we had an extra drawdown of about 8%. However, our PNL compared to the buy and hold was significantly over 100% higher. So that's a pretty nice thing to see. That's kind of what you want to see. You want to reduce variance, reduce your drawdown, but whilst maximizing returns. And so if we look at our returns, so in total, only $800 of capital was used, and if you were to just buy and hold GLD over the 3-year period, you would have made 53.85% return. However, our strategy produced 129.8% return, which is considerably higher. So this here is the back test. I hope that solidifies the power of this strategy. And now let's go into our live account and see how we can actually implement this and place this trade, and so you guys can follow along. I'm going to show you step by step exactly what to do. So GLD we've already got open. Now you want to open up the tab where you can see a list of option expiration dates. Now remember, as part of our entry criteria, the first thing we want to look at is the volatility. We use the VIX in the back test, but we're going to use IV rank in real life. IV rank will produce better results. You want to only take trades on positions on underlyings that have an IV rank of at least 30. This right now is at 62.7, so that's perfectly fine. And then we want to write contracts with 45 days left till expiration. In the back test, we waited for exactly 45 days. However, in reality, you can be anywhere between 30 and 60 days out in time. We have got a 45-day here on the April 4th weekly. Normally, we don't do weeklies or quarterlies. However, because this is GLD, it is pretty liquid, so we shouldn't really have any issues. So 45 days out, we're just going to click on April 4th. But if it is an underlying that isn't as liquid as GLD, just stick with the monthlies. So in this case, let's just pretend that we didn't want to go with the weekly or quarterly. We'll just go with March 21st or April 17th. That's still within our 30 to 60 day range. But in this instance, we'll go with the weekly, April 4th, 45 days out in time. And now we can see the options chain. So if you remember on the back test, we sold one put and we bought one put, and we sold a put at the 30 delta and we bought a put at the 15 delta. Okay, so our puts are on the right hand side. So if we go over to our delta, we've got a 30 delta here at the 263 strike, and then we have a 15 delta here at the 255 strike, and that's it. That's the trade setup. That's literally exactly how it looks. Our short put is at 30 deltas and our long put is at 15 deltas. If we have a look in the bottom left corner, we have a pop, which is probability of profit of 74%, and we have a P50 of 82%, and that is the chance of hitting at least 50% of max profit at some point over the next 45 days, or over the length of the contract. That's 82. Well, now it's at 85%. So we're looking at probabilities of success of between 74 and 85% here. Okay, we would collect $1.70 upfront in premium. That multiplied out by the contract multiplier is $170. So we would collect upfront $170, and our broker is going to require $631 to open this trade. So we're getting a nice and healthy return here over 45 days. Once you've seen the back test, gone through the back test, that should give you the confidence to start placing trades. Now, once this order has been filled, our $169 in premium would get added to our cash balance automatically, and then at that point, all you need to do is just manage the trade. Now, management, if you remember on our exit criteria, comes down to two things. So number one is if the trade hits 50% of max profit, you close out. And number two is if you haven't hit 50% of max profit and you are approaching 21 days till expiration, you close the trade. Now, 21 days worked well because the initial entry was 45 days, and in this instance, this is this contract or this expiration date is 45 days out, so 21 days will still apply. But let's say, for example, you sold you placed a position where the expiration date was, say, 35 days out in time, because for whatever reason the contract the expiration date selection just wasn't right. You didn't have weeklies or quarterlies. Let's say if the underlying wasn't as liquid, whatever it might be. Let's say you went in a 30 to 60 day range. 45 days wasn't available, so you went with 35. In that instance, you want to change your exit criteria, so still keep the 50% of max profit, but you wouldn't want to get out at 21 days at that point. You'd want to get out at around about halfway through the time duration. So if it was, say, 35 days left on the contract when you placed the trade, you probably want to get out about 15 days. If it was, say, 50 days at the beginning of the trade, you probably want to get out still at 21 days. 21 days would always be your maximum, but you can go a little bit lower than that if you had to place a trade with less than 45 days on the contract, if that makes sense. But if you do need to do that, you want to be around at the halfway point, and that limits your gamma risk. So with that being said, that's the back test, that's the strategy. This is how you deploy the strategy, and you now know how to manage the strategy. All you need to do is go and do it. And you do need to keep in mind your buying power requirement, because let's say, for example, if you have $1,000 in your account, you do not want to be placing this trade, which is going to take up over 60% of your portfolio. That would be not a very smart idea. So in order to figure out how much buying power you should be using, we've created a free position sizing template. The link is in the description. Just click the button and it will take you to this spreadsheet. The way it works is you enter in the size of your portfolio at the top. So say if you have a $10,000 account, you can then enter in whatever the current VIX level is. So say if it's 35.1, or let's just say 25.1, just so we can see the numbers change. And then everything will be automatically calculated for you. So it will tell you the amount of buying power you should be allocating to your defined risk trades, undefined risk trades, etc. The way this works is by looking at the size of your account, of course, and also the VIX level. It assesses, the volatility in the market, and will then dynamically tell you how much of your portfolio you should be allocating. Because when the VIX is high, our edge is high. So it's perfectly fine to be more aggressive when we have a higher edge, and this will dynamically calculate everything for you. If you would like to learn in more detail about what we do and how we do it, again, link will be in the description. This time click on EDS Premium. Get yourself signed up. Inside you will have access to our portfolios that will allow you to see the positions that we're placing, how we manage risk, how we make adjustments, all of it in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you ever get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee, so once you have studied the full course and followed some of our trades, if after 6 months you are not profitable, then we will work with you for free until you are, or you can just simply request a full refund. So it's completely risk-free. Right now it's $9.99 a month to join. The price will be increasing. This is our second wave. Our first wave of members signed up for £1 a month. The second wave of members, the price is $9.99. Once the second wave is full, the third wave, the price will increase thereafter as well. So it's not a sales tactic. You genuinely are rewarded for getting in early. The aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. We want to give you the skill. Once you've learnt it, you can take it with you for the rest of your life. No one can ever take it away from you. And we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.